Welcome to the deep dive. Today, we are really digging into the mind, the thinking process of, one of the giants of the 20th century when it comes to making decisions, Charlie Munger.
Yeah, for decades. He was the maybe quieter, but definitely the intellectual force alongside Warren Buffett, the co-architect really of what Berkshire Hathaway became.
And our goal today, we're using Trent Griffin's book, Charlie Munger, Complete Investor, as our guide here. We want to get past the famous quotes and, boil it down to the core wisdom.
Right. What makes Munger's approach so powerful isn't just that he was, incredibly smart, is that he built this system, a rigorous cross-disciplinary method. He called it a trained response, actually.
Yeah, trained response.
Yeah, designed specifically to avoid the common pitfalls, the errors that trip up most people, especially in investing.
Okay, so we're not hunting for a magic stock formula today. It's more like an operating system for your brain. Better thinking, better decisions, drawing on ideas from way outside just finance.
Exactly that. His big insight, I think, was realizing that the real long-term edge doesn't come from being a genius in one little box. It comes from pulling together the big ideas from everywhere: psychology, history, math, physics, even biology. He understood that to really succeed in investing, you first have to grasp how your own brain is kind of wired to trick you, to make you fail.
That's fundamental.
It is. And understanding that is what we're exploring today, how he built that defense mechanism.
Okay, let's get started on this journey into Munger's thinking. And maybe the best place to start is with that famous, almost counterintuitive idea of his. So here's the question. How does a billionaire investor like Charlie Munger, operating in, the super complex world of global finance, achieve this legendary success but basically focusing on just being consistently not stupid? It almost sounds like he's aiming low, doesn't it?
It does, yeah. It sounds deceptively simple, but really championed simplicity because he saw complexity as, well, just a minefield, a training ground for errors. He believed that if you could tune out folly, as he put it, just swat away all the unimportant stuff, the noise, it clears your head. It makes you better able to pick up a few sensible things to do.
Okay.
You know that old Cold War anecdote he loved about unnecessary complexity?
Ah, the space pen. NASA spending millions while the Russians
Used a pencil. Exactly. So simple. Munger applied that thinking constantly. He stayed away from things like complex derivatives, companies with really opaque financials, anything that needed some super fancy model. Just understand.
If it was hard to value, he just skipped it.
Pretty much. Put it in the too hard pile. His view was, look, most people try to make money by tackling really complex problems. Munger figured he could make money by just getting really good at avoiding the complex problems he didn't understand.
Okay, so it's not just avoiding complexity passively. His main method is actually looking for what to avoid. Tell us more about this inversion idea.
Inversion is, well, it's really the backbone of how he thought. Instead of asking the usual question, okay, how do I achieve X? Like, how do I succeed? You flip it. You ask, what are all the ways I could definitely fail? What are the guaranteed paths to disaster?
Like listing out the failure modes.
Precisely. So for investing, you list things like taking on too much debt, making decisions based on emotion, buying something without a safety net, a margin of safety.
And once you list them,
you just systematically avoid those things, eliminate those paths. And the path that's left, well, it's much more likely to lead somewhere positive, almost by default.
so when he looked at a potential investment, how did that inversion actually play out? What was the first question?
The first question wasn't, wow, how much could this make? Not at all. It was always, okay, what's the downside? What could go wrong here that I'm maybe not seeing? And if that bad thing happens, what's the absolute maximum damage?
Thinking about the worst case first.
Always. He used to say, it's remarkable how much advantage people like him got over the long haul, just by trying to be consistently not stupid, instead of trying to be, some kind of market genius. The biggest mistake, he thought, is not realizing how shaky your positive arguments might be. And what's really fascinating is how the top tier thinkers, that sort of 1%, use this idea to really define what they know and what they don't know, their circle of competence.
Right, Socrates, Confucius knowing the limits of your ignorance.
Exactly. It's about understanding the downside. Think about a professional tightrope walker. Their entire career, their life even, depends on knowing exactly where their balance fails, what tiny shift could make them fall.
They live by managing downside risk.
Constantly. They survive by spotting it and reducing it.
So the average person is maybe focused on maximizing the gain, chasing the upside.
While the best investors are thinking first and foremost about minimizing the risk of losing capital permanently.
That's a huge difference in mindset.
It really is. And it explains why truly great investors are often willing to, well, look a bit boring during the really hot bull markets. They sit out the silliest stuff.
Because they know it prevents catastrophic losses later.
Right. When the inevitable correction comes, they're protected. They understand that being smart often just means avoiding being really stupid.
So the takeaway here is pretty clear then.
Yeah, I think so. Focus your energy on spotting the dumb path, the obvious ways to fail, and just eliminate them from your options. If an investment or any problem really feels way too complicated, too hard to get your head around easily, just put it aside. Put it in that too hard pile.
You don't lose points for not playing a game you don't understand.
Exactly. Move on to something clearer.
Okay, so Munger and Buffett always hammered this point. Short-term market moves, the daily ups and downs, they're basically irrelevant noise. Focusing on that is playing a, quote, loser's game. If we tune out that noise, what's the absolute anchor? The non-negotiable truth for value investing.
The first, absolutely essential bedrock principle is this. You must treat a single share of stock as exactly what it is, a small proportional piece of ownership in the underlying business.
Not just a ticker symbol flashing on a screen.
No, absolutely not. This idea comes straight from Benjamin Graham, their mentor. It forces you to think like you're buying the entire company in the private deal. Imagine there's no stock market tomorrow, no easy way to sell. Would you still buy this business at this price?
So if I buy, say, a share of a big bank stock, I'm not buying a blip on my phone app. I'm actually buying a tiny fraction of their loans, their buildings, their employees, their future profits.
Precisely. And therefore, any valuation has to start with the business itself. The fundamentals. What does it sell? Who are its customers? Who's trying to beat them? What do the key numbers look like? It's bottom-up analysis.
Okay.
For a Graham value investor, the stock's value has to be tied to the present value of all the cash that business is likely to generate over its entire lifetime. Anything else, Munger would say, is just speculation.
And speculation is?
Trying to predict what other people will do. Guessing the behavior of emotional human crowds.
Why is trying to predict crowd psychology such a dangerous trap?
Because it spins out of control so fast. It leads you right into what John Maynard Keynes called the beauty contest.
The newspaper contest analogy. I remember this one.
Yeah, Keynes compared the stock market to a contest where you don't pick the faces you think are prettiest. You have to pick the faces that you think other people will think are the prettiest.
So you're not judging beauty anymore. You're judging other people's judgment of beauty.
Exactly. And it doesn't stop there. You start thinking, okay, what do other people think is the average opinion?
Right.
You get into these second, third, fourth levels of guessing.
It becomes completely circular.
Totally untethered from the actual underlying thing. You stop analyzing the business value and start analyzing mob psychology, which is, notoriously fickle and irrational. The best investors just refuse to play that game.
So speculators focus on the price, investors focus on the asset.
That's the core difference. Speculators worry about what the price will do next week. Investors worry about what the business will do over the next 10 years. And this ties straight into that 1% insight. The really top thinkers. They just reject the illusion of precision that comes with financial forecasts and projections.
Buffett famously said he had no use whatsoever for them.
Right, because they often create this false sense of knowing the future. Munger agreed completely. He pointed out that projections are usually put together by people who, have a vested interest in a certain outcome.
A subconscious bias creeps in.
Or even a conscious one. And the apparent precision, all those decimal points, it just makes the whole thing misleading, fallacious even. For someone like Munger, the track record, the present data, what's happening now, that's what matters. Future guesses, especially from people trying to sell you something, are highly suspect.
That raises a huge practical challenge, though. The market screams prices and news at you 24/7. How do you actually ignore all that and just focus on the business?
You have to consciously choose your role. Are you an owner or are you a trader? If you want to be an investor, your job is to analyze the value of the underlying asset, period.
And if you want to speculate,
then you guess the price direction. By making that conscious choice, I'm an owner, I focus on the business, and committing to ignore those short-term forecasts, you sidestep the biggest trap, basing your decisions on everyone else's emotional guesswork about tomorrow.
Okay, we've established that figuring out the true worth of a business, its intrinsic value, is, as Buffett put it, terribly important but very fuzzy. It's not a precise number. So if you can't nail down the exact value, how does a smart investor actually protect their money and, ensure they make a profit, how do they avoid overpaying?
This is where the margin of safety comes in. It's absolutely fundamental. Munger insisted this principle will never be obsolete. And simply put, it's just a favorable difference between the price you pay for something and its indicated intrinsic value.
So it's a buffer.
It's a buffer, a cushion. Its main job, according to Graham, is to make unnecessary and accurate estimate of the future. You don't need to predict things perfectly if you have that safety net.
It absorbs the inevitable errors and bad luck.
Absolutely. The classic way to think about it is trying to buy a dollar for 70 cents or maybe 60 cents or 50 cents. You want a significant discount. That discount protects you against two things. First, your own mistakes in estimating that fuzzy intrinsic value.
Because you will make mistakes.
You will. And second, it protects you against unexpected bad stuff that happens to the business itself, a new competitor, a recession, dumb regulations, whatever.
I like the analogy Trim Griffin uses in the book here, the driving one.
Oh yeah, the freeway analogy is perfect.
Yeah.
Margin of safety is like keeping a really safe following distance when you're driving. If you tailgate someone at high speed, you need superhuman reflexes and perfect prediction of what they'll do next. Otherwise, splat. But if you leave a generous gap, your margin of safety, you don't need to predict anything perfectly. You just need to react to what's happening right now, because you know you have enough time and space to brake safely, even if your initial estimate of their speed or the distance was a bit off.
Makes sense. But didn't Graham originally use this idea differently, buying those really beaten down cigar butt stocks? That seems different from what Munger ended up doing.
It is different, and that shift is a really critical evolution in value investing. Graham, remember, lived through the Great Depression. So his initial focus was finding companies that were just incredibly cheap, statistically cheap. These were often terrible businesses, the cigar butt stocks.
Why cigar butts?
Because they were like discarded cigar butts found on the street. Maybe you have one last free puff left in them. You'd buy them for less than they'd be worth if they just liquidated everything, sold off the inventory and equipment.
So you buy them for pennies on the dollar, wait for that tiny puff.
And then sell quickly. The problem Munger saw, especially as the economy changed after the war, was that these were fundamentally low-quality businesses. They rarely grew, they often had bad management, tough competition, you had to keep finding new ones constantly, and many just slowly died.
So Munger pushed for a shift.
Yeah, Munger and Buffett together realized that in the modern economy, the truly massive returns, the compounding magic, came from owning high-quality businesses over long periods. So they adapted the margin of safety principle, instead of buying junk at a huge discount.
They started buying wonderful businesses at a fair price, or maybe a slight discount.
Exactly. The underlying principle, buy for less than it's worth, stayed the same. But the quality of the asset they were buying improved dramatically. They recognized, though, that even the best business in the world isn't worth an infinite price. So the margin of safety still applied. It protected them from getting caught up in hype and overpaying, even for quality.
But hang on, if intrinsic value is fuzzy, doesn't demanding a margin of safety just mean you're making a more conservative guess? It doesn't make the guess itself more accurate, does it?
That's precisely the point. The top 1% of investors, they aren't trying to win by being slightly more accurate with their fuzzy estimates. They don't make investments where success hinges on getting the second digit of the computation exactly right.
They're not looking for tiny edges.
No, they're looking for the obvious bargains. Situations where the discount is so large, so clear, that it requires no complex math. It should be, as Munger liked to say, overpoweringly clear and positive. They demand that deep discount precisely because they know their estimate contains errors. The margin absorbs the error.
And they see risk differently too, right? Not as volatility.
Absolutely. For them, risk isn't about how much the stock price bounces around day to day, which is what beta measures in academia. Risk is the possibility of permanent capital loss. And that risk is determined almost entirely by the price you pay. The lower the price relative to the underlying value, the lower your risk.
So you're aiming to be in a position where you can actually afford to be wrong, maybe significantly wrong, and still come out okay, maybe even make a profit.
That is the goal. That's the takeaway. You have to strive for that significant discount from your best estimate of intrinsic value. Enough so that you can make mistakes, because you will, and still protect your capital. Violating this, paying full price or more because you're utterly convinced you're right, that risks permanent loss. And for Munger, that was the cardinal sin of investing.
All right, let's talk about the market itself. It's emotional, it's wild, it swings dramatically between fear and greed. Most people get whipsawed by it, frankly.
Yeah.
How can an investor possibly turn that chaotic, unpredictable behavior into a massive personal advantage?
This is where Ben Graham's brilliant Mr. Market metaphor comes in. It's maybe the single most useful idea in all of finance for keeping your head straight.
Explain Mr. Market for us.
Okay, Graham asks you to imagine you have a private business partner named Mr. Market. And this partner is, well, a bit unstable. He's manic depressive. Every single day he shows up and offers to either buy your share of the business from you or sell you his share.
Okay.
But his mood swings wildly. Some days he's completely panicked, irrationally depressed. He sees nothing but doom and gloom ahead, and he'll offer to sell you his share for ridiculously cheap prices. Just wants out.
And other days?
Other days he's euphoric, totally over the top, convinced the business is going to the moon, the future is infinitely rosy, and he'll demand an absolutely exorbitant price if you want to buy his share.
So he's swinging between crazy pessimism and crazy optimism.
Exactly. And the key, Graham said, is that you get to decide whether to deal with him or not. You are not obligated to trade at his offered price. His mood doesn't change the underlying reality of the business.
So the value investor's job is to exploit Mr. Market's mood swings, not get swept up in them, use him as a servant, not let him be your master.
Precisely. You only engage with Mr. Market when his offer is clearly advantageous to you. When he's depressed and offering things way too cheap, you buy. When he's euphoric and offering way too much, maybe you sell.
And the rest of the time?
You just ignore him. Let him rant and rave. Because the market is just people voting with their money, driven by emotion, the folly Munger talked about. That folly is the fundamental source of opportunity for the rational, patient investor. Think about it from the perspective of a true business owner. If the market price of your stock suddenly drops by 30%, but you know the underlying business is still doing just fine, is that bad news or good news?
Well, for a rational owner, it should be good news, right? You can buy more of the business cheaper.
Exactly. It's like Buffett's hamburger analogy. He said, I'm going to buy hamburgers the rest of my life. When hamburgers go down in price, we sing the Hallelujah chorus in the Buffett household. If the price of something you want to own more of goes down and its intrinsic value hasn't changed, you should be happy.
Okay, but that takes incredible emotional discipline. When the headlines are screaming, see arsh, and everyone around you is panicking and selling, the normal human instinct is to run for the hills, hoard cash, not jump in and buy more. How do the best investors conquer that powerful psychological urge?
It takes real courage. It boils down to that famous advice, be fearful when others are greedy and be greedy when others are fearful. When the herd is panicking, selling everything regardless of price. The great investors recognize something crucial.
What's that?
That the risk hasn't gone up, it's actually gone down. Because the price has fallen so much, the margin of safety is now much wider.
Ah, it connects back to margin of safety. Lower price equals lower risk.
Right, so that's precisely the time they choose to act. Aggressively, decisively. While everyone else is paralyzed by fear, they step up. Munger said they are very action-prone when it's obvious, and the 1% insight here is how they balance patience and action. They understand that most of the time, the right thing to do in the market is nothing. Just wait. Be patient.
But when the fat pitch comes...
Exactly. When Mr. Market, in one of his fits of depression, offers up an undeniable bargain, something clearly within their competence and with a huge amount of safety, they have to overcome that social pressure, that general feeling of doom and gloom, and act with conviction, with size.
Because those opportunities are rare.
Very rare. If you wait patiently for years and only get a handful of truly great opportunities, you can't just take a tiny swing. You have to swing hard. That courage to stand alone, to act when everyone else is frozen or running away, that's often the final differentiator.
So patience is the waiting game, and courage is acting decisively when the wait is over.
That sums it up perfectly. And the practical takeaway is this. Don't waste your energy trying to predict the market's next wiggle. It's futile. Instead, cultivate the patience to wait, maybe for a long time, until it presents you with a truly compelling opportunity.
And if you know you can't handle that emotional roller coaster?
Then Munger was very clear. If you know you're likely to panic when others panic, or get greedy when others get greedy, if you can't keep your head when all about you are losing theirs, you are far better off just putting your money into a diversified, low-cost index fund. Essentially, outsource the emotional control.
Okay, Munger clearly believed that investing success wasn't just about mastering finance or accounting models. He talked a lot about needing worldly wisdom. What exactly did he mean by that? What kind of intellectual toolkit is required for making consistently great decisions?
Worldly wisdom, for Munger, was about building and using a broad framework of fundamental knowledge from many different disciplines. He called it a lattice of mental models.
A lattice, like a crisscrossing structure.
Exactly. He argued you need to draw the big foundational ideas from fields like psychology, history, mathematics, physics, engineering, biology, and weave them together. The goal is synthesis. You want to see how these big ideas interact and apply across different situations.
Why was that so important? Why not just get really, really good at financial analysis?
Because, Munger argued, reality itself is interdisciplinary. Problems rarely fit neatly into one academic box. Relying on just one model, even a sophisticated one from your own field, is dangerous because it might be precisely wrong.
Precisely wrong. How so?
Well, take standard economic models. They often assume perfect rationality in market participants. That model might be mathematically elegant, precise, but it's fundamentally wrong because it completely ignores the powerful, often irrational psychological biases that actually drive human behavior. Or it ignores historical patterns of bubbles and crashes, or the physics of how crowds behave under pressure.
So focusing only on what's easily measurable in one field can blind you to more important factors.
That was his fear. People tend to overweigh the things they can quantify, the things that fit neatly into spreadsheets and statistical analysis, and they often ignore the harder to measure stuff, like, say, the quality of a company's culture, the long-term incentives of its managers, or the strength of its brand loyalty, things that might actually be far more important for long-term success. So Munger was really advocating for becoming an intellectual generalist. He loved quoting the biologist Julian Huxley, who said, "Life is just one damn relatedness after another."
Seeing the connections.
Yes. If you understand concepts like critical mass from physics, or feedback loops from engineering, or natural selection and ecosystem dynamics from biology, you start seeing parallels and connections in business and markets that a narrow specialist would completely miss. This integrated framework lets you see the whole system, not just the tiny part your discipline focuses on. This broad, synthesizing approach is why thinkers like Munger often get described using Isaiah Berlin's analogy of the fox and the hedgehog, which Philip Tetlock popularized in forecasting.
The fox knows many things, the hedgehog knows one big thing.
Right. Munger was the quintessential fox. He knew a lot about a lot, allowing him to adapt and combine ideas flexibly. The hedgehog, who knows one big theory incredibly well, tends to jam every problem into that single framework, often leading to failure when the problem doesn't fit. Bill Gates even called Munger truly the broadest thinker he'd ever met because of this range.
Wow. Okay, but that sounds incredibly demanding. Do we all need to become experts in physics and psychology and history just to make good decisions?
Well, not necessarily experts in the academic sense. But the key is cultivating intellectual humility and committing to continuous, broad learning. And crucially, Munger emphasized the importance of not fooling yourself, which he thought was the easiest trap to fall into.
How do you avoid fooling yourself?
He was almost ruthless about analyzing mistakes.
Yeah.
He famously said he liked people admitting they were complete stupid horses' asses, because learning from errors is vital. He believed you have to actively rub your nose in your mistakes. Yeah, but the idea is, by dissecting past failures, using your whole lattice of models to understand why you failed, and constantly actively looking for evidence that disproves your current favorite ideas. That's how you genuinely improve your thinking over time. It's about intellectual honesty.
So the takeaway isn't necessarily to get PhDs in 6 fields, but to embrace that lifelong learning across disciplines. Build that mental toolkit.
Exactly. Build that flexible framework. And, maybe most importantly, keep using inversion. Actively hunt for your own errors, your own biases. Constantly challenge your own best thinking. That's the path to worldly wisdom.
Right, we think we're rational beings, making logical choices. But Munger spent a huge amount of time arguing that our brains are fundamentally wired with these systematic biases, these shortcuts that lead to, well, boneheaded mistakes, especially with money. Which psychological tendencies did he see as the most dangerous for investors trying to think clearly and independently?
Oh, he cataloged a whole list of them, these dysfunctional heuristics. Basically, mental shortcuts that maybe made sense for survival back on the savannah, but cause all sorts of problems in modern complex environments like financial markets.
Where should we start? What's maybe the biggest one?
Well, you have to start with the prime mover of human behavior: incentives. He called it the reward and punishment super response tendency.
Super response, meaning it's incredibly powerful.
Understatement of the century. People radically underestimate the raw power of incentives to shape beliefs and actions. Munger loved quoting Upton Sinclair. It's very hard to get a man to believe non-X when his way of making a living requires him to believe X.
So people subconsciously convince themselves that whatever benefits them financially is also the objective truth.
Absolutely. And this is just critical for investors to grasp when they're dealing with anyone in the financial industry. Brokers, advisors, bankers, you name it.
Why specifically them?
Because their incentives are often misaligned with yours. Many are paid for activity, for complexity, for selling high-fee products. Their incentive isn't necessarily to give you the simplest, best advice like, say, buy a low-cost index fund and hold it for 30 years.
Because that doesn't generate big fees.
Exactly. So they are powerfully incentivized to believe and to convince you that the more complicated, expensive strategy is actually better. And Munger's point is, they're not necessarily lying consciously. They will genuinely persuade themselves it's true because their livelihood depends on that belief.
Okay, that's huge. What about the pressure to just go along with the crowd? That seems to drive massive bubbles.
Yeah, that's the social proof tendency. We are fundamentally herd animals, especially when things are uncertain or confusing. We look around to see what everyone else is doing and assume that must be the right thing.
Safety in numbers, even if the numbers are running off a cliff.
Pretty much. Munger gave examples like oil companies in the 60s all mindlessly rushing to buy fertilizer companies just because their competitors were doing it. Turned into a total disaster, he said. Social proof is rocket fuel for financial bubbles. Prices start going up, people see others getting rich, they assume those people must know something.
Fear of missing out kicks in.
Right. FOMO, combined with social proof, creates a stampede into overpriced assets. And fraudsters, like Bernie Madoff, weaponized this brilliantly. They used the prestige of their existing clients, the social proof, to lure in others who desperately wanted to be part of that exclusive, successful crowd.
Chilling. Okay, and what about that deep-seated fear of losing money? That seems almost universal among investors.
Oh yeah, that's the deprival superreaction tendency, or what psychologists now often call loss aversion. Decades of research show this. Losses hurt way more than equivalent gains feel good.
How much more?
Roughly 2.5 times more, psychologically. Losing $1,000 just stings much worse than the pleasure you get from gaining $1,000.
And how does that trip up investors?
In a couple of key ways. First, it makes people irrationally cling to losing investments. They hate crystallizing the loss, so they engage in hope investing, praying it will just get back to even if the rational move is to sell and move on.
But get evenitis.
Right. And second, it can lead to irrational risk-seeking. To avoid facing a certain loss, people will sometimes take wild gambles they wouldn't normally consider. Munger used the example of the gambler at the racetrack who's down big near the end of the day. Suddenly, they start betting huge amounts on crazy long shots, hoping for a miracle win just to erase the pain of the existing loss. They take on massive risk to avoid the psychological pain of deprival.
Wow. Our brains are really not built for rational investing, are they? It sounds like a psychological minefield out there. How do the top 1%, the Mungers of the world, navigate this? How do they escape their own programming?
Well, first, they intensely study these biases in themselves and others. They recognize that it's precisely other people's psychological errors, their emotional reactions, that create the opportunities for the rational value investor.
Mr. Market's mood swings are driven by these biases.
Exactly. And second, they work relentlessly to develop that trained response we talked about earlier. A conscious, rational override system to counteract these built-in biases. It makes them kind of like intellectual mutants, as Munger put it, in their orientation.
And they're especially wary when multiple biases team up.
Yes. That's what Munger called the Lollapalooza effect. That's when several of these tendencies combine and reinforce each other, creating this powerful psychological whirlwind that pushes people into, frankly, idiotic behavior.
Can you give an example of a Lollapalooza?
The classic one is an open outcry auction for something desirable, like a piece of art or maybe a company. Think about all the forces at play. You've got social proof. Seeing other smart people bidding makes you think the item must be valuable. You've got the commitment and consistency tendency. Once you start bidding, you feel psychologically invested, committed to winning. You don't want to look like you quit.
Right, ego gets involved.
Big time. And then, crucially, deprival superreaction kicks in hard. As the price climbs higher and higher, the bidder stops thinking, am I paying too much? And starts thinking, oh my God, I'm about to lose this thing that I already feel like I own.
That fear of loss drives them to keep bidding past the rational point.
Way past it. All these biases feed off each other, amplify each other, and boom, someone pays a completely irrational price. Buffett's simple, practical defense against auction lollapaloozas, he just says, don't go. Avoid the situation entirely.
That is incredibly powerful. The takeaway here seems to be all about intense self-awareness and maybe situational awareness, too.
Absolutely. You have to be hyper-aware of the incentives acting on others, especially the people giving you advice. And you have to be brutally honest about your own wiring, particularly that deep aversion to loss. And one more thing, Munger stressed. Rational thinking gets severely impaired under extreme stress. Pavlov showed this with dogs. Stress could cause a total reversal of conditioned personality.
So the practical advice is,
never, ever make major financial decisions when you're under intense emotional pressure, whether it's fear, greed, or something else entirely. Step away. Cool down. Let the rational brain come back online.
okay, we've covered discipline, mental models, psychology, but Munger also talked constantly about sticking to what you know. How can understanding your own limitations, knowing what you don't know, actually become a huge competitive advantage? How does that help ensure you only swing at the pitches you can really hit?
It's by rigorously defining and then staying strictly within your circle of competence. This means limiting your investments, your major decisions really, to areas where you possess genuine, deep expertise and understanding.
Not just familiarity, but real expertise.
Real expertise. Munger believed that trying to operate outside that circle, trying to be smart about things you don't truly understand, is a recipe for disaster. It's far easier, he argued, to avoid problems you don't understand than it is to try and solve them. The most famous example, of course, is how Munger and Buffett stayed away from high-tech stocks for decades, especially during the dot-com boom.
Right, they got criticized for missing out.
Heavily criticized.
Yeah.
But it wasn't because they thought tech was inherently bad or wouldn't produce winners. It was because they admitted they didn't feel they could reliably predict the long-term winners and losers, the durable competitive advantages in industries changing that fast.
So they prioritized staying within their known boundaries over chasing the hot new thing.
Exactly. They preferred businesses they could understand, where they felt confident about forecasting the economics 10, 20 years out. Certainty and durability for them required that deep understanding.
So it's not about how big your circle is, it's about knowing exactly where the edge is.
That's the crucial part, knowing the perimeter. Buffett loved the example of Rose Blumkin, Mrs. B, who built the Nebraska Furniture Mart. He said she knew exactly what she was good at and she had no desire to kid herself about those things.
She knew her circle.
Perfectly. Munger basically said, look, if you're only really competent in a few specific areas, but you stick religiously to those areas, you can do just fine, maybe even great. The danger is confusing mere familiarity with actual competence.
What's the difference?
Well, you might use a certain software product every day or fly on a particular airline all the time. That's familiarity. But it doesn't mean you understand the competitive dynamics of the software industry or the complex capital structure and union contracts of the airline business. That requires deep, specific knowledge.
Okay, so how do the top 1% apply this concept differently than, say, an average investor who just buys stocks of companies they've heard of?
The key difference is that the great investors seem to be much better at identifying the boundaries of their incompetence and actively avoiding those areas than they are at just picking winners within their circle.
It's the avoidance again.
It's the avoidance. They see the circle of competence as fundamentally an exercise in opportunity cost. You have limited time, limited brain power. Where can you apply it most effectively? Where do you have a real edge? And crucially, when they do find one of those rare, obvious, mispriced opportunities squarely within their circle,
Where the margin of safety is huge and they understand the business inside out.
they don't just nibble, they bet big. They load up, as Munger would say. They don't diversify away their absolute best ideas just for the sake of diversification. If you really know you know something, and it's cheap, you act forcefully.
How do you know if you really know?
Munger had a simple test. If you have genuine competence, he said, you pretty much know its boundaries already.
Right.
If you have to spend a lot of time wondering whether something is inside or outside your circle, it's probably outside.
So the final advice boils down to rigorous self-honesty about your skills.
That's the takeaway. Commit to a really tough, honest assessment of what you truly understand deeply. If an investment idea falls outside that circle, or if understanding it would require months of learning a whole new field from scratch, the rational Munger move is usually to just pass. put into the too hard pile. Your best long-term results will likely come from the few things you know exceptionally well.
We touched on this earlier, how Munger's thinking evolved from Graham's original approach. Why did he ultimately conclude that buying a merely fair business at a wonderful price, that classic Graham cigar butt strategy, was actually inferior to the goal of buying a wonderful business at a fair price?
It really came down to understanding the incredible power of long-term compounding. Graham's cigar butts, remember, were often mediocre or even bad businesses, bought solely because they were statistically dirt cheap.
One last puff.
One last puff, then you sell. There was usually no compounding value within the business itself. Munger realized, especially as the economy grew more complex and competitive after the war, that the truly big money, as he put it, wasn't made by flipping these cheap, low-quality stocks. It was made by owning high-quality businesses for very long periods.
Why? What did the quality give you?
It gave you internal compounding. A wonderful business, one with durable advantages, can consistently reinvest the profits it generates back into the business itself and earn very high rates of return on that reinvested capital.
So the business itself grows in value year after year?
Geometrically, ideally. It becomes a compounding machine. A cigar butt stock bought at liquidation value simply can't do that. So Munger shifted the focus heavily towards identifying that business quality, and the defining feature of quality, for him, became the durable competitive advantage, what he and Buffett popularized as the economic moat.
The moat, protecting the castle.
Exactly. The moat is what protects the business's profits, the castle, from competitors trying to invade and take them away. A strong, wide moat allows the business to keep earning those high rates of return on its capital over long stretches of time. Identifying and assessing the strength and durability of that moat became central to their analysis.
Okay, let's break that down. What kinds of moats did they look for? What gives a business that durable protection?
They identified several key types based on where the advantage comes from. First, you have supply-side economies of scale. This is often about sheer size and cost advantages. Think about huge railroads or essential pipelines, or maybe the only power grid in a region. The cost for a competitor to replicate that infrastructure is just astronomical, maybe impossible. That protects them.
Hard to compete with massive fixed costs already sunk.
Very hard.
Yeah.
Second, you have demand-side economies of scale, which we usually call network effects now.
Where the service gets better as more people use it.
Exactly. Classic examples are credit card networks like Visa or American Express, or maybe a dominant online marketplace like eBay or Amazon Marketplace. Each new user makes the network more valuable for all the other users, creating this virtuous cycle that's incredibly difficult for a new competitor to break into from zero.
Right. Who wants to join the network with no one on it?
Precisely. And third, and this was one Munger particularly valued, is the power of strong brands, especially when they translate into pricing power.
Tell us the famous See's Candy story. That seems like a key moment in their thinking.
It really was. When Berkshire bought See's Candies, a West Coast chocolate company, they started to realize they had something more than just a candy maker. See's wasn't just selling chocolate, it was selling tradition, nostalgia, a gift associated with holidays and special occasions.
An emotional connection.
A powerful one. So they started testing its price sensitivity. They found they could raise prices year after year, often well ahead of inflation, and customers barely blinked. They just paid up. Because the value wasn't just the chocolate, it was the brand, the trusted quality, the gift-giving ritual, the emotional association. The price was almost secondary for many customers. Munger called the discovery of this huge, untapped pricing power the ultimate no-brainer.
Because it means you can pass inflation costs straight through.
And then some. It makes the business incredibly resilient, especially in inflationary times, and dramatically boosts profitability. Finding a business with latent pricing power became a huge goal. And the 1% insight here, I think, is how ruthlessly they prioritized the structure of the business, the moat, over the person running it. Munger absolutely wanted managers who thought and acted like owners. That was crucial. But
the moat came first.
The moat came first. They looked for businesses that were so inherently strong, so well protected, that they could survive even if run by, quote, an idiot manager.
The idiot manager test.
Exactly. Obviously, they hoped for brilliant management on top of a great business, but the business's fundamental strength was the prerequisite. As Buffett often said, when a manager with a reputation for brilliance tackles a business with a reputation for bad economics, it's usually the reputation of the business that remains intact. The manager gets chewed up. So they focused on the enduring strength of the business itself.
So the final evolution leads us to focus squarely on that durable advantage.
Yes. The takeaway is, invest only in businesses where you can clearly identify and define the economic moat, understand why competitors can't easily replicate its success, and then test its strength. Look at the numbers. Does the company consistently earn profits well above its cost of capital? Has it done so for a sustained period? Munger suggested 5 years or more of data gives you much better odds that the moat is real and not just temporary luck.
If you can't explain the moat simply, it probably isn't there.
Or at least it's not strong enough or durable enough to bet on.
Wow. We have covered an incredible amount of ground today. From the seemingly simple power of inversion and avoiding stupidity, through the bedrock principles of ownership and margin of safety, the psychology of Mr. Market, the need for worldly wisdom, right up to the focus on quality and economic moats.
It's a comprehensive system.
It really is. And Munger's view seems to be that achieving sustained success doesn't necessarily require superhuman intelligence, but it absolutely requires what he called the right stuff, the right temperament.
Yeah, the patience, the discipline, and maybe above all, that courage to act decisively when the time is right, but do nothing most of the time.
It's a long game.
Absolutely. The rewards, the really big rewards, belong to the patient. But patience isn't passive waiting. It has to be combined with that readiness, that aggression, when opportunity finally knocks loud enough.
Munger often suggested you need the discipline to sit quietly, maybe for years, waiting for that obvious opportunity.
The fat pitch. The fat pitch. But then you need the courage to swing hard and heavily when it finally arrives. If you're hoping the market will make you rich next week or next month, Munger would say you're almost guaranteed to fail, probably because your emotions will betray you.
A fantastic framework, really, for better thinking overall, not just in finance, but in life.
I think so. And maybe a good final thought is this. Whenever you're faced with a really complex or difficult decision, whether it's an investment or something else entirely, and you find yourself unsure, maybe ask yourself, what would Charlie Munger do?
And the answer is usually.
The answer is usually, do nothing. Unless the bet is blindingly obvious, ridiculously cheap, squarely within your circle of competence, and offers a margin of safety so wide that you can afford to be wrong. That intense patience, that focus on avoidance first, that might just be the ultimate secret weapon. Thank you for listening. See you in the next video.